Well, g'day there, traders and friends, market participants, and enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down as at the close on this Tuesday and bring you a market update. What I'll also be speaking about very briefly are two particular stocks which I addressed over the weekend in Pivot Point Pro. They are both Amazon and BIDU because they have made some very interesting moves to start the week, something which I spoke about in great detail over the weekend. And also, in addition to that, we have seen some form of a reversal take place in the US dollar index today, something, again, which I was speaking about over the weekend and expecting to happen. Well, as at on Tuesday, we have seen that reversal right around that macro support area where, unfortunately for a lot of bears, or at least people with a bearish perspective looking at the US dollar, they have probably been found out trying to find short exposure on the US dollar as it looks to be breaking around that 93 area on the US dollar index. A very strong intraday reversal again has just taken place, and it looks as though we have put in maybe perhaps even a macro low, no doubt in my mind at all, sometime or at least some sort of a short-term low, and I am expecting the US dollar to actually appreciate further into 2016. So I'll give you a quick update on that particular currency as well. But before I get there, let me just quickly speak about some of the market movements which we've seen take place to begin this current week. Now, on Monday, we saw a relatively healthy bounce across the board. On the S&P 500, we saw a very nice bullish pop. However, today, as at the close on Tuesday, we have given back all of those gains plus a few more points. In fact, on the weekly chart, we have just pushed into negative territory, only down 2 points. We do have what we call the spinning top candlestick, but this is only the formation of that weekly candle after two trading sessions. We still have Wednesday through Friday to move through. What is interesting, however, is that once again, we are pushing off from this declining bearish trend line, and we may look back at this and say, well, this was the final, push off from this 2100. And we never actually came back to retest this level. There's a very high probability that this is the final print that we are going to get up and around these levels on the S&P and also on the Dow Jones Industrial Average. A little bit different for the NASDAQ because I am expecting still that gap fill to take place. It just depends on, well, do we start seeing these macro pushes or at least price momentum push below these macro sell signals 2017 on the S&P 500? And if that happens, do we set up the last short-term higher low, which will then push these markets back up for the final retest and then the ultimate roll? That's just pure speculation, or really just how I'm sort of addressing these markets at the moment. But really what we can do as technicians is just have a look at this on the daily chart, especially if we are swing traders. And that is exactly what I am and how I personally trade the US financial markets. But as you can see, the S&P 500 here, have a look at this. We've got this high dating back to mid-April. We've put in another secondary lower high, and then if this is a failed push on Monday, well, this is the establishment of a third lower high. On top of that, we're breaking below the 10. We're also breaking below the 20 exponential moving average. The next stop on the S&P 500 is down here about 2043. That's obviously going to coincide with that 50 exponential moving average. However, people who understand exponential moving averages know that these are simply not going to act as long-term support. So when we are in a bullish trend, the exponential moving averages will act as support. It will act in many ways like a trampoline, and it will propel price higher when it pulls back into those exponential moving averages. The same is true for a bearish trend. So when we're in an established bearish trend, the exponential moving averages will act as resistance when we bounce back up into them, and then price will push off from either the 10, the 20, or the 50, depending on just how advanced that bearish trend is. The big differentiation going on right now in the financial markets is that we are not trending. We are neutral, technically neutral, although we have a lot of bearish macro signals which are saying usher, or at least look at these markets on the side of caution. So as I'm sitting here speaking about the exponential moving averages, I'm not looking at them and saying, hey, the 50 is going to act as a long-term support. That is not the case. Generally what happens is that buyers will gravitate around these areas short-term until they essentially break, or until they effectively break. So I am ultimately looking for the S&P to push on down below 2043 and ultimately start interacting with our very large macro sell signal, which we're looking for confirmation across all three of the US markets. If I change the oscillating indicators, now these help us when we are in a neutral state in the financial markets. You can see we have very strong sell signals on the daily chart. You can see the Stokes is still pushing down. The RSI has moved below that neutral 50 area, and The MACD has got multiple points of bearish divergence as price on the S&P has pushed up into its relative high here around 2,100. So these are some short-term bearish signals for the S&P 500. When I go out to a larger time frame, I'm now looking at this market on the weekly chart. Ask yourself the question, is this a bullish or bearish signal on the stochastics? All right, so when the markets push up on the weekly into an overbought state, especially when we are not trending and especially when we are moving sideways between established support and resistance, well, then you want every opportunity to sell up and around the highest level on the weekly stochastic. So you can see right now, if I zoom in on the detail, we are about to get that weekly cross, which we have been waiting for since we established the February lows in 2016. We're saying, look, this is a natural oscillation back up into most likely declining resistance. That has essentially and effectively run its course. And now we are about to establish that bearish sell signal. It doesn't mean that the market's going to do this over the next week. That is not the case. But once and again, this handbrake is completely pulled on the market. And I've referenced some of these candlesticks on the weekly charts over here, saying that, look, we're starting to see the establishment of some very troublesome signs for the market. It doesn't mean that we are set to roll, but there's a very good chance that we're going to stagnate up at these levels. And this is exactly what has happened. Well, then we're just waiting for, ultimately the momentum to start shifting back down to the opposite direction, which may take a week, it may take two. But I wouldn't be playing around or at least holding intermediate, even swing trades to the upside. Now, this really flows into, I've only addressed the S&P 500 at this point, but just on that note, it's a really good segue into these two individual stocks. I just said, look, I wouldn't be holding, any short-term swing trades which are bullish, because again, on the daily and on the weekly, which is about to coincide, also with the monthly, they are all showing us not only bearish divergence, but some macro sell signals, which are all in alignment in different time frames. So how does that flow back into our individual trades? A big theme over the weekend was confirmation across the three markets. And although we still don't have them, and that is pushing below those macro sell triggers, which I've referenced in the previous video, we can see a lot of weakness starting to stem into, or at least flow into, a lot of other individual stocks. If you take a look at BIDU, for instance, on Friday, we had a very nice intraday reversal, and we had this 180.57 trigger open this particular week. Well, as you can see on BIDU, it's somewhat capitulated. We have a very strong gap, which started, or at least kickstarted this trading week. We have another secondary gap right here. It's looking like a complete reversal gap, and our expectations of lower prices on BIDU are most likely going to be filled. Again, entry at 180.57. It's trading at 174.32. We've already made over $6 in this trade to the downside. Now, when you look at this, against a trade like Amazon, we were speaking about this over the weekend, and I was very reluctant to place any sort of continuation bullish trigger, even though we'd established this really nice bullish gap on the back of that earnings, all right? Now, Amazon is pushed on up. It had a very nice continuation on Monday, but again, look at this inside day candlestick, which is set up as at the close on Tuesday. If anyone wanted to sort of continue the trade above Amazon, they're really holding a lot of risk at the moment. And it's my expectation, all right, it's my forecast that Amazon is going to give a very sudden, a very quick reversal off from this gap fill. So if you pay attention over to here at the beginning of 2016, where all of the markets were gapping down to start 2016, and they went into that approximate 2-month bearish frenzy. Well, Amazon at the moment has more or less closed that gap. So when we put this into, unison with the NASDAQ itself, or Amazon's finished the gap fill, there's a very good chance that this reverses, and this is going to unfortunately catch a lot of novice people out who are trying to jump on the bandwagon with Amazon, so to speak, as the sentiment behind the stock is most bullish. If you couple that with the NASDAQ, again, I'm still expecting the NASDAQ to somehow get back up to 5,000, even though it looks like it's not going to happen, because really the NASDAQ is the weakest of the three markets. If you pay attention to this, we've got these island reversal gaps where not only have those, or at least the setup and the continuation of those triggers, we still have this opening gap setting back to the beginning of 2016, and we're breaking below macro support. We're already below where we were for the entire month of April. Have a look at that. We closed at 4,673, and we're already eating into the gains which we established soon after that base in February as we traded towards the end of March. So, this is a very quick reversal taking place on the NASDAQ, and it makes a lot of sense. Again, on the daily time frame, we are somewhat oversold on the NASDAQ, but we can remain like this just as long as we remained overbought during the bullish move to the upside, and people need to understand that. So you've got the sell signals again, multiple points of bearish divergence playing out on the NASDAQ, as I was warning about for a number of weeks leading up into this resistance top close to 5,000. These are all bearish. The RSI is short-term oversold, but when you ask yourself the question, is the NASDAQ oversold on the weekly chart, what type of answer do you get? I mean, to me, this looks, on the weekly that it is very much so overbought. And really, that is the answer. I'm just sort of, speaking it to you, or at least trying to position myself so you can come to that conclusion as well. But look, we're about to get that cross in the weekly stochastics. It's fact, it's in front of you right now. And it's something that you need to at least, say, yeah, I can see that. And am I going to live with, the potential that this market rolls at this point? And again, taking that, or at least putting that into consideration, ask yourself, has the NASDAQ made or established a higher high since mid-2015? No, it hasn't. We've established now the third lower high. So this is current. As at the close on Tuesday, the RSI is not oversold, nor is it overbought. It's very neutral. And the MACD is still in bearish territory. On the weekly chart, we're starting to see the downtick of the histogram as well, which means that these two signal lines, or at least the fast line, is starting to converge closer to that slow line, which is indicating that a bearish cross is going to take place on the MACD as well. So soon we'll have these two different time frames in agreement. And then when you zoom out to the monthly chart, just have a look at this. You tell me what part of this is bullish. You've got the Stokes on the monthly chart facing down. You've got the RSI again, very, very weak. The MACD is crossed bearish. Go back in time and do this, or I suggest that you go back in time and have a look. The last time these three indicators were in agreement to the downside, well, that was essentially the top in 07-08 before the bottom fell out. The only other time previous to that where the market had established lower highs and lower lows and started to see these divergences or long-term macro sell signals was back at the turn of the millennium in the year 2000. You can see how that all played out as well. So some big warning signals out there still. And again, a lot of people have their head in the sand saying that, look, for whatever reason you're wrong, this is the case. And maybe I am, that's entirely fine. But when these signals, when these indicators, when these chart patterns, when a market stagnates sideways for close to 2 years, you really need to sit up and take note of it and say, well, what if we do see some continuation to the downside? What levels will really shift me into a defensive stance, or at least talk about or think about positional hedges, long-term hedges on the market in case, eventually we break these macro support levels over here, say 15.5 on the Dow, 1,850 down here on the S&P 500, and on the NASDAQ, it's going to come in about 4,200. That will be very scary if that happens. Obviously, we're a long way away from that, but it looks as though, once again, we're seeing that top, much like we saw in November, December. People are still reluctant to acknowledge this, and the longer that they, dismiss it and the lower prices go, well, then ultimately they will have to flip those positions. And again, just be selling, or at least closing out of their longs, contributing to some of the selling pressure which we're starting to see across the three markets. This shouldn't take anyone, as a surprise whatsoever. It's very easy to see, but I'm still under the assumption that we are going to see a bounce, maybe even from this level here. I'm still very much so open to it. And it's all dependent on the NASDAQ finally closing that gap. And we also have some breakaway gaps after that earnings island reversal just here. So you got this gap just here, and you which could very well be filled as well. So we essentially have two gaps. If you go back out to the New Year's Eve gap, it puts us in all the way up at about 5,080. I don't know if we have that much left in the tank to move, but what I'm thinking about right now, and made very clear over the weekend, well, where am I macro, right? Where does the weight of the evidence just completely shift hard negative immediately and long term? And I've addressed that with people in that class. They know where those triggers are. And the lower we move over the next week or two, the closer we get to those macro entries. And then you really need to be positioned more or less at that point in time, because things in the past when these macro triggers have effectively been hit or moved below, and this is a very long-term bearish trigger, which I've been eyeing off for quite some time. Once that happens, things generally fall apart relatively fast. Now, again, it's not 100%. Nothing in the world of technical analysis or finance is bulletproof or 100%, but it really is just a calculated sort of entry based on past market movements below certain critical points, right? And that's what I've been doing and spending my time doing, back trading and back testing and going back historically to see what works best. And I'm very comfortable with those pivot points. So if you want to learn where they are, have a look at that class. Now, what I'm going to do right now is just quickly address the US dollar index, because today we saw that intraday reversal take place. Although we haven't seen a massive push to the upside, we certainly have established that longer lower wick. And again, this is something which I spoke about over the weekend. it was my assumption and belief that people were going to get caught out on the downside. That is exactly the case at the moment. This isn't a trigger, by the way. This was a wait and see close and then a continuation below this. It certainly wasn't enter, say for instance on the UUP whatsoever, but it looks as though back on the daily chart, see that long lower wick which has established itself over the past 24 hours of trading on the currency? Well, generally that's a really good indication that price is going to snap back to the upside. So if you pay attention, have a look at old macro support, you get like these rough pivot points of where price generally turns. So at support, for instance, you get the bounces, right? And then when you get back up into resistance, you have turns which are bearish, right? So you get the bullish move turning into a bearish move. Well, it looks as though this is the beginning of the bullish move for the US dollar, a nice little intraday reversal by that lower wick. If you go back and have a look at other turns which have been made, you've seen some very quick advancements on the US dollar, and that's what I'm expecting to happen for the US dollar. So again, none of us are short whatsoever. We've been expecting this reversal to take place, and unfortunately a lot of people to get into, or at least be triggered into a whipsaw. That is what has happened on the US dollar index. So pay attention to this. Now that we have this long lower wick, I'm happy to put a short in this 91.70. The reason why is because I don't expect it to happen. But I am expecting, again, further appreciation for the US dollar moving forward. Very interesting, look at what the US dollar is doing, because a lot of people have turned bearish on the US dollar, and I'm still find myself in the bullish category. And I think this is just a healthy consolidation which is taking place right now. And eventually it is going to, resort back into the long-term bullish trend. It's just nice for markets, or at least currencies, to digest higher levels. We are, if I go back and show you this, we did have a very strong price appreciation throughout the second half of 2014, and we've just really been consolidating sideways. So I'm happy with the price movement. We may see a breakdown, technically speaking. If that does happen, we're looking at the US dollar coming back down to about 88, at a bare minimum. But I think this is a critical pivot point, a turning point, and we are going to start oscillating our way back up to 96, maybe even as high as 100 again on the US dollar. Stay tuned, I will keep referencing that. But, as at the close, I think I've just recapped what it is I wanted to speak about, how it is that we can sit out of, these types of trades which are bullish, where we just don't have much conviction in the overall markets themselves, and how that can be a real hindrance if you're looking for, short-term long trades even, and how when we're looking for confirmation across three markets into the bearish side, you can really see how bearish stocks start to begin the process of moving lower. BIDU is a really good example of that. And when the momentum of the market is on your side, stocks will move in that direction. So the hardest thing at the moment, being a technician, or at least being a market participant, an active market participant in the financial markets at the moment, is that there really is no clear direction yet in terms of the primary trends. So there's a lot of people saying I'm bullish for these reasons, or I'm bearish for these reasons, and they're probably all valid points. Price direction hasn't triggered. It hasn't given us a legitimate, look, we're bullish, we're bearish. Sure, you can take hedges, you can position yourself in advancement of a rollover based on your own analysis, based on someone else's analysis, whatever the reason is. But you need to find on the markets those critical areas where, again, probability suggests and historical price behavior suggests that once you push beyond certain limits, whether they are bullish or bearish, that you expect the market to continue in that direction. That's what we have labeled. We're happy with those price levels, and now we're sort of just playing the waiting game on the market itself. And we have seen a relatively mixed start to this trading week. We are slightly negative on the S&P. Let me just quickly show you it on the Dow Jones Industrial Average, down a whopping 22 points. That's a little bit of sarcasm. It's not the biggest move, but again, a little bit of a spinning top here on the Dow Jones. But, the Nasdaq's just been the weakest of the three markets, down 12 points to begin. If this level breaks, you can see the short-term support being built here. It's going to be a very quick move down to, again, 4.575, and these are some pretty important levels technically for these markets, which I'm paying very close attention to. So I have spoken for a little bit longer than what I ideally wanted to, but I hope that's given you a good update as at the close on Tuesday. I'm not sure if I'll be back later in the week. I'll just I'll inform you when I'll inform you of a major market advancement when that advancement happens. And I don't want to overdo it in terms of pointless analysis. I just really wanted to recap that Amazon, that BIDU trade, speak about the US dollar, because that was a very important move today. And I can see that reversing back up to the upside. So, take that for what it's worth. and just the weakness again, which is starting to flow into the equity markets. Also, in alignment with that weekly sell signal, which we've been very patient on. It is about to happen, right? We've been very, very patient on this. It's actually been more or less 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost 3 months. Okay, I've been waiting for this bullish move to bounce. People took part in it. Personally, I didn't, just because I don't like trading counter trend in a primary bearish move, because I just simply don't know where that roll will take place. I acknowledge that, but we're at the limits of it, and this is a major, major, major problem for financial markets up at around these old resistance levels. And I don't see the US financial markets breaking above the 2015 highs. So what does that mean for the markets? Well, if we're at more or less the extreme point, as in a bullish bounce, well then, the easiest, or the path of least resistance, is to the downside. All right, that's my basic approach to the financial markets. You can agree with it, you can disagree with it, that's fine. I'm just happy to share that with you. So on that note, everybody, it's James signing off on behalf of Pivot Point Trading. Have a fantastic Tuesday evening, and I'd encourage you to have a look at Pro if you haven't already. Some interesting analysis going on in that weekend class. All right, so all the best, everyone. I will see you at some later date. All the best. Goodbye.